Hello, everybody. It is Thursday, September the 1st, 2022. It's 5:38 p.m. We're here to do our now bi-monthly debt-free life infinite banking training events. So we've got some folks here that have joined us, some of which are agents. We've got a special guest, Mark Creighton from Mutual Trust. And some folks here are clients just here to hear more about the infinite banking concept in the debt-free life program. So without further ado, let's go ahead and get to the normal standard presentation. So it's almost like I've never done this before. All right, there we go. So welcome. This is the Debt-Free Life program. We're here to talk specifically about the Debt-Free Life program, which is a proprietary program offered through Symmetry Financial Group and now Quility. And so what this program is, that the words debt-free life is kind of a play on words. The idea is that we want to get you debt-free if you've got debt. And we also want to get you to a situation where we're taking advantage, especially using some of the advantages of life insurance programs as the vessel in which we store, hold, and grow money, and taking advantage of life insurance because it provides us some protections. Certainly tax deferred, if not tax exempt style protections from the IRS, addressing IRS tax codes 7702A, 162 if you're in business, and now 101J is a new tax code that references this as well. So moving on. So the Debt-Free Life program, if we look at what this program is designed to do, it's designed to get you out of debt. So we ask a couple of standard questions. So number one, if you had an opportunity to get out of debt in 9 years or less, would you do it without you spending any more money than you're spending right now? And number two, are you 100% certain you're going to have a great retirement? And that's today's advanced topic is going to be derivative new annuities that are going to be derived from debt-free life programs. So that's the last half hour. So moving into this piece, looking at retirement, this can be used as a retirement program. It's never too late to start, and everybody should start. But one of the key things that we look at with these two questions is why are we always answering these questions the way that the standard answer comes? Why is it that if anybody gets an opportunity to get out of debt in 9 years or less without spending money, they're going to do it? And why is it that people have debt or have doubts about their debt and about their potential retirement? And I'm going to tell you, it's because of this. It's because the average American has this, and this is how their finances are set up. They spend about 34% of every dollar that they make on interest. They spend about 40% of every dollar they make on taxes. They use about 23% of every dollar they make to pay the bills, put food on the table, put gas in the car, pay the power bill, maybe have some money left over to go out to eat once in a while. And then finally, because we as Americans are only saving about 3% of our income, that's problematic. If you think about what you make right now, how much money you make and how much money it costs you to live your life, why do people think that 3% is going to be enough to do what they're spending 100% on now? And, even if it gets to the point where you've planned it all out and you're going to have a reduced cost of living when you're retirement, 3% is not going to be enough. If you're relying on the Social Security Administration, they just came out with some new guidance, which is great. The Social Security Administration is not going to be bankrupt in 3034 now. Everybody's got breathing room, right? It's going to be bankrupt in 3035. Okay, so you get another year, but really what they're going to do is they're going to reduce, and this is what they've already said, they're going to reduce the Social Security payments by 25% to be able to make it solvent, to keep it running for all of us. So what that means is, unfortunately, a lot of the back end baby boomers that are relying on Social Security are going to be relying on family. And they're going to have to be finding other vehicles. So it's not too late. And that's kind of a theme I want to talk about on this presentation. It's not too late to get started. And with these programs, you don't have the luxury. If you're over 50 years old, you don't have the luxury to start a retirement program where you can weather a downturn in the market. And let me put that in perspective for you. So since 2000, from 2000 to 2020, the market gained an average of 5.9% per year. That does not mean they gained every year. That just means the average over time was 5.9%. And if you were invested in a program that is tax deferred, where you're going to have to pay taxes out on that money, and your program had a 5.9% average growth per year, when you started taking the money out and you started taking those taxes, and you had those years where you had a loss or no gain, then your actual realized return is only 1.7%. Let that sink in for a second. It's massive. So with this program, the worst case scenario, if you look at any of the carriers we do, the worst case you're going to get is 3% growth. So what we're talking about is the worst case scenario with these programs, you're going to get 3% growth, which is almost double what you would have received in a tax deferred investment strategy. So this is, in my opinion, definitely superior to those 401s, 403s, TSPs, FERS, KEOS, SEPs, whatever. All right, so let's move on. So next is when we look at the American population, the average American makes about $2 million in their lifetime. This is old. This is a little bit higher now, hopefully. But the reality is $2 million is a lot of money if you store it, save it, and spend it right. The problem is we don't. We're not taught how to spend money right. We're going to talk about that in a minute. We're not taught to save money right. And guess who's teaching us how to do these things? It's the banks. It's the bank's best interest for them to keep us in debt. It's the bank's best interest for us to be reliant on the banks for their financial future and the federal government. And unfortunately, if anybody has any illusions about trusting the federal government for their retirement, I've got some books you need to read. Anyway, when we look at where this all started, this is not the American dream. This is not what we wanted. We're only saving 3% of our total income. For anybody who's making more than $60,000 a year now, if you're the traditional American, what that means is you're banking that 1 year of salary is enough for you to retire on, and it's incorrect thinking. So, looking at this, when people are approached with this particular scenario as the average American, what are you going to do when you're in debt? How you have to eliminate that interest component about what you're spending. You're going to meet with a debt counselor or a credit counselor or a debt negotiator or a debt consolidator, and they're going to give you these bullet points that you see on your screen. And unfortunately, all of these will fail at some point, with the exception of a debt snowball. And that's only if you're doing a real debt snowball. So these solutions that you're told and that you're unfortunately spending money to try to do, it's not going to work. So the better way is the way that we're trying to show you right now. Here's the better way. So if I can get you from the left side of your screen to the right side of your screen, and I can change it so that you're spending 10% less on taxes, which is actually 25% over time less, or if I can get you to spend 12% less in interest, which is significantly more, that's over 40%. If I can save that money and you're making the same amount of money, then where's the money going? So you got two other sides of this equation, which are for you. And those sides of the equation are your lifestyle and your savings. So the lifestyle, that's your Hulu bill. That's your taking that vacation with the family. That's your sending Scott Forehand a box of donuts just because he likes donuts, right? That's that money. And then the taxes or the savings part, that's your retirement. So what we're talking about doing here is we're talking about reducing the amount of interest you pay over time, reducing the amount of taxes you pay over time, increasing your lifestyle money. That's today money. That's cash flow. And more importantly, increasing by a factor of 500% how much you're saving for retirement. If we can do that, then your retirement becomes significantly easier. And couple that with the other piece that this is, debt-free life, right? Couple that with eliminating your debt. If your retirement, Sean Boatman, if you retire and you're making $5,000 a month, but you've got $4,000 a month as debt service, let's say you retire making $5,000 a month with $0 debt service because we eliminated that. How much more comfortable is your retirement going to be? So I would posit to all of you guys, all of you folks out there, eliminating your debt before you retire should be a critical thought. It should be a critical process. It should be a critical goal. because having that done, performing it that way, getting that piece out of the way, makes your retirement comfortable, makes your retirement so that you, unfortunately or fortunately, you don't have to go to Walmart and get a part-time job as a greeter just so you can put groceries on the table. It's unfortunate, but that's pretty common that we see these days, especially with the current economy. So how do we do this? Well, it's pretty simple. We reduce the amount of taxes you're going to pay to lenders because we eliminate the debt early. We're going to eliminate your debt in 9 years or less, which is not taxes to lenders, but interest. That reducing or eliminating those debts in 9 years eliminates the downline interest, that amortized interest, the compounded interest that you're going to be paying. Reducing your taxes, that's because we're reducing your tax exposure. It's not that you're going to pay less taxes. It's not that we're going to do any of that, but we are probably going to be able to change your tax bracket, and we're probably going to be able to change the money that you pull from these programs, the amount of tax you're going to owe on that, with probably the most tax advantaged situation I can think of, which is tax exempt. And then that final piece is that improve your cash flow. So here's something we know about these programs. If I created a program for you that was going to require you to spend more money than you're making right now, the chances that program is going to be in play or in force or still working for you a year from now is pretty much zero. Okay, so if you're tight already on money, putting one of these programs in place that costs you money is going to make it even tighter, and it's not going to fly. So we have to find money that you're spending inefficiently. We're going to talk about that in just a second too. One of the key differences between this, and there's multiple versions of infinite banks and private banks out there, but one of the key versions of this program is that we looked at the other 10 reasons, the other 10 programs, primary programs that are out there, and looked at why they fail. And there's different reasons why they all fail. They all have their own Achilles heels. But the one primary thing that caused them all to fail is that they made an assumption that you can't make. And that assumption is that you're never going to have a hiccup with your income, whether that means you pass too soon, lose your job because you get fired, lose your job because a pandemic hits, lose your job because they want you to retire and they want to hire somebody who's 20 years younger than you and pay them 40% less to do your job. There's all kinds of reasons why that can happen. It's an external force in all cases, and worst case scenario being you pass. But that's why this piece exists. What did we do? We made it so that there's money hidden in your program that you can get to in an emergency. We planned for that emergency. Now, this is a true emergency, Sean Boatman. This is not the emergency that, oh, my friend just got back from Tahiti. They explained how nice it was, and I think I need on an emergent nature to go to Tahiti. This is not that. This is a true emergency. My XYZ loved one just got cancer, and they have to stop working. And the only person who has any money that can help support that family is me. So I'm going to drain this program to help support that family. That's a true emergency. All right, moving on. When we compare these programs, all right, to other programs that are out there, there's three kinds of taxed status. You can be taxed, where you're paying the tax on it. You can be tax deferred, where you're saying, I'm not going to pay the tax now, I'm going to pay it later. Or you can be tax exempt. So in all cases, no matter how you look at this, if you consider this as an investment strategy, the standard investment of $10,000, invest in a tax deferred, tax exempt, or completely tax status with the same number of years of investment, the same growth rate at 7%, which is high, and the same tax rate at 25%, which is low, then there's no way that any of those programs can exceed the growth and value of a tax-free or tax-exempt program. The math just doesn't work. It cannot happen. Okay. So what does that mean? That means, Ted Brenna, the guy that invented the 401k, says the 401k isn't what it's supposed to be. It doesn't work the way that it's supposed to be. The government has too much control over it, and you've lost control when you put money into it, because you're now putting money and you have no idea what you're going to be paying when you pull that money out. If anybody's under any illusion that taxes are going down, again, I've got some books you need to read. If you think that taxes might be going up, I would agree with you wholeheartedly. If you know that taxes are going to go up, I agree with you wholeheartedly. So why would you want to put money into a tax deferred program, not pay tax now, just so you can pay more tax on it later when you pull the money out? You may actually be in a lower tax bracket, but that doesn't mean you're going to pay less taxes, right? So from an investment perspective, this is in my opinion, far superior to any taxed vehicle or tax deferred vehicle that you can use. All right, so that's enough on that. This is a financial instrument. All financial instruments work the same way. They work in the form of in phases of maximization, accumulation, distribution. In this case, our maximization phase, if you have debt service that you're currently making, our maximization phase is focused on eliminating that debt as quickly as we can. All right. So what does that mean? That means I'm going to find places where you're spending money inefficiently. I'm going to stop you from spending it inefficiently if you listen to me. I'm going to start using that money to rapidly eliminate your debt. I'm going to create a true debt snowball, and we're going to get you to the point where your debt service is zero, which means now you've entered the accumulation phase, which means all the money I have that I'm comfortable investing, all the money is going to be stored and it's going to grow in perpetuity. That's a key thing here. So you have other programs like a 401k. The minute you take money from a 401k, you've diminished the performance of that downline. So in this case, these programs that we structure, we're never actually touching the principal. We're only touching a loan, and we're using that loan collateralized with the principal. We're taking the loan, and then the principal amount is still growing permanently with a guaranteed income as well as the dividend stacked on top. Finally, we enter the distribution phase. And this, Sean Boatman, is the phase where you can take that emergency trip to Tahiti, because at that point, the money's yours. You don't need to grow it anymore. You're retired. Do what you want to do. It's your money. Remember, you're the banker. You're the one who makes the decision whether or not you want to loan yourself the money, and make sure that whatever you're loaning yourself the money is an appropriate use of the money. All right, let's move on. This is not a new program. This has been around for over 100 years. These programs, some of the people you see on your screen, Disney, Doris, Christopher, Ray Kroc, and Warren Buffett, these are people that did these programs while they were growing their wealth, or are still doing these programs while they continue to grow their wealth. If you think that maybe the richest people in the world or the most successful finance people in the world know something and they're doing this program, maybe you ought to listen. As far as in the media, this is something that is getting a lot of traction now. Bloomberg did a big story about this about 4 months ago. Dan Bongino did a big story about this about 7 or 8 weeks ago. This is something that we are having a lot of traction. This is actually Symmetry's flagship product, the purpose of which we're on a march to eliminate $1 trillion of consumer debt. And this is how we're doing it using these programs. But all the people on your screen have done this before. Some other notables, John Rockefeller did this to create generational wealth. J.C. Penney did this to fund the lean times in the 1920s. The Rothschilds did this. This is, there's a book out there, What Would Rockefeller Do? Yeah, that's what this is all about. All right. So in the process of doing this, we're going to tell you to do some things. We're going to show you how the program works. And here it is. We're going to, as I've already said this, we're going to direct inefficiently spent money. So here's an example of an inefficiently spent dollar. I have $1,000 of debt that I owe on my car, and I take $1,000 from my checking account and spend that money on my car payment, and I pay that car off. I've just transferred $1,000 of my cash to $1,000 of eliminated debt. If you look at it from mathematically, it's 1,000 for 1,000. It's a wash. I have zero gain. But if you use our program, then you put the money into your private bank first, and then take a loan against it, and then pay the car off. Then what do I have? I still have my $1,000 cash. I still have $1,000 of reduced debt. And now I have $1,000 loan, which is going to pay itself off over time, or I'm just going to cycle through it as I would normally, which means I now have a 100% gain. We'll talk about that in just a minute. All right. This is some stuff that we looked at specifically when we first started this program back in 2018 or 2019? I can't remember now. But these are some of the original people that we did these programs with and had some success. This is standard. These numbers are actually much smaller than what we're seeing now. Some of the clients I'm looking at when I meet with them, they've got millions of dollars in debt, and we're eliminating millions of dollars in debt in the same period of time. Okay, so the amount of debt is irrelevant. The speed at which you eliminate the debt with these programs is based on the number of debts that you have and your ability to fund your debt service. So this is how you currently spend money, which is the way the banks have taught you to spend money. So you make money, it gets deposited into your checking account. Doesn't matter who you use, Wells Fargo, Citibank, Bank of America, whatever. The bank uses your money over and over and over again every night to lend it out at the federal funds rate or higher. The average dollar that you put into your checking account makes your bank 61 cents. The average dollar you put into your checking account is lent out 7 times before you actually get to use it. And in the process of using it, you say, hey, bank, go ahead and send that money to my creditor. It's my car company. And then your money has become their money. And that money's gone forever and you can never get it back. So what we're talking about, spending money more efficiently, this is how we do it. So you take the money, goes right as income, goes into your checking account again. And now instead of it staying in your checking account, letting the bank use it over and over and over again, we're going to go ahead and pay a premium for our life insurance policy. This life insurance policy is whole life. It's specific, though. It's participating whole life. That word participating is important because what that means is we are able to participate with the financial performance of that company, and we're able to make a gain with our money. All whole life gross cash value. Actually, there's probably some that don't, but there's whole life policies are known because they grow slowly, grow cash value. Well, we're turning that on its head using participating life, and we're getting a very high guaranteed interest rate. In addition, we have a term life rider. So this is more death benefit. We have to do that in order to take advantage of the tax code, because the tax code says if the cash value of a life insurance policy exceeds the life insurance value of the life insurance policy, that life insurance policy isn't really life insurance. It's what's called a modified endowment contract, and it's taxable. So by adding in a term life rider, we increase the umbrella of coverage so that we can grow the cash value underneath. And eventually, we've got another piece I'll show you in just a second that we don't need that term umbrella anymore because the cash value is growing, but the death benefit is also growing, and we're fine. That third piece is a paid up addition. Paid up addition is a couple of things. It is life insurance. It is paid up life insurance. It is life insurance that once you pay for it, you don't have to pay any more for it again. It's going to be self-supportive. So if you think of it in terms of an investment, this is an investment that you can buy that won't ever lose value, that you don't have to worry about it being stolen. You don't have to spend any money to maintain its value. And I know with 100% certainty how much it's going to be worth 1 year, 5 years, 10 years, 50 years from now. It does not lose value. So if anybody's ever invested into precious metals, they go up and down. While they're a relatively safe investment, you don't know what the value is going to be. If anybody's ever invested in an oil well, if you strike, it goes through the roof. If you don't strike, it's a great way to waste a lot of money. If anybody's ever invested in the real estate market, real estate goes up and down and up and down. You don't know where it's going to go. I can tell you right now, based on the market and the mortgages and the mortgage interest rate, real estate prices are probably going to go down a little bit. So there's going to be some loss. So if you're in the buying and selling of real estate, then you're unfortunately not in a good place right this minute. So all these other investments that are supported by collateral, the collateralized investments, whatever they are, they work, but there's no guarantees with them. You don't know what the value is going to be. And you're guessing, you're hoping that the future works out the way you want it to. And my friends, hope is not a good investment strategy. Okay, it's a nice word, but it's not a good investment strategy, right? So don't hope your strategy is going to work. No, it's going to work. And that paid up additions is where you know it's going to work. Why? Because paid up additions, it's valuable. It's always going to have value. It's not going to decrease. As a matter of fact, Banks know that so well that they buy life insurance policies all the time, especially if they're paid up, and they'll pay you pennies on the dollar. If I've got a life insurance, paid up additional life insurance policy that's worth $1,000 and I die tomorrow, my family's getting $1,000. So the bank knows that, and the bank they'll find these companies called viatical settlement companies that go out, they find these policies, they'll offer you 5 cents, 10 cents on the dollar, and then they'll sell it to the bank at 20 or 25 cents on the dollar, and that's the bank's investment. So Wells Fargo is known for this. They have 28, I think it's $28 billion of their tier one assets in structured life insurance programs like this. J.G. Wentworth, structured indemnity programs, same kind of deal, right? So I've got this money, I move it out of my checking account, I send it up into my private bank. And now I've moved that regular compounded growth. I've moved it so that it now works for me instead of working for my bank. But now I have to pay my debt. How do I pay my debt? I don't touch the principal. I never take the principal out. All I do is I take a loan using the cash value of my program as collateral. That carrier loan that I'm taking, and Mark Creighton will talk to this in a minute because he will tell you that they are happy to make those loans because that's why that company exists. That carrier loan, do you owe tax on it? Nope. Why not? Because it's a loan. When you bought your house, did you pay tax to borrow the money? When you put that money into your account to buy that house, did you have to pay tax on it? When you bought your car, did you pay tax on it? You might have paid, license fees, tag fees, stuff like that, but you didn't have to pay tax on the $30,000 or $40,000 you spent on the car. Loans are not taxable. That's IRS tax code, right? So I take a carrier loan. I take a loan against the cash value of my company. I deposit it back into my checking account. I take that money. I tell my bank to go ahead and pay my debt. The bank pays my debt, transfers the money out of my checking account to the lender, to the person that I owe the money to. And where's my money? I still have my money. It's still in my private DFL bank. It's still sitting there, it's still earning interest, still earning a dividend. And where's my debt? My debt's paid. What's my gain? 100%. So let that one sink in for a second. So here's an example of how this works. So can you see does it say Debt-Free Life Bank at the top of the screen now? Yep, great. Okay, this is working. So for a while, this wasn't working right. So this is a client that I did back in 2019, Halloween 2019. And this person had some significant debt. Actually, it was a young family. And when you look at those debts, some of those look pretty onerous. And the one that sticks out like a sore thumb is student loans. Student loans are evil, people, right? So student loans are an abomination. They serve a purpose, but they end up basically putting on handcuffs to the client for whoever does it for a long time, unless you get lucky enough to have some good income. So they've got the standard mix of stuff. This was a couple, they had both been married before. They both had houses. They've got some debts. One of the people was at that time a candidate for a PhD candidate. So she now teaches at William & Mary as a doctor. And so all that's done and taken care of. So this is what they were looking at. And they were looking at, because of the student loans, they were looking at 40 years of debt service. So at the end of 40 years, what would have happened to this company, this couple? They would have been debt-free in 40 years, which puts him at age 76. They would they'd have equity in 3 properties. That would have been their retirement savings, the equity in those 3 properties, but that's it, because they would have been paying on this debt forever. Their true debt, it's not $584,000. That's if they could write a check tomorrow to pay all the debt off. They'd have to write a check for $584. Their true debt was $767 once you look at the scheduled interest. The scheduled interest was $182,000. Wow, right? So what did we do for them? Not 40 years, 7.8. And actually, they've accelerated the program, because now that they've seen the program, I had a meeting with them about 2 or 3 months ago, and they are actually ahead of schedule because they've been throwing extra money at it, which is awesome. So a couple of things I want to point out here. This is math. Math doesn't lie. Okay. So the math that we show here if they did exactly the plan that we told them, which is pay these debts off in this order, pay the premium that we discovered they were spending inefficiently, and then pay it on this schedule, then they will be out of debt in 7.75 years. The reality is it's going to be faster than that because they're doing some advanced strategies that we're going to talk about. One of them is they're doing a mortgage chunking routine. So for that last from year 4.42 to year 7.75, that 3-year run, they're actually doing mortgage chunking, which is going to eliminate those two debts 16% faster. So their track is actually be out of debt in 7.2 years. Pretty strong. So when we look at this as an investment, is this an investment? Yep. Why do I say that? I'm saying that because they're going to turn what would have been equity only in their homes as a retirement program to equity only in their homes plus $4.8 million in the same time frame. Is that a pretty good investment? Yeah, right. They're going to save $70,000 of interest. Where's that money going? It's going right into their retirement plan. It's money they were going to spend. Now they can spend it on their future as opposed to spending it on their past. Okay. So this is a scenario about how we look at when we're going to be paying off these debts. Every one of those yellow bars that you see on your screen is a year in which they're going to be paying off some debt. Many of those, because these folks have so many debts, many of those are going to be years where they're paying off multiple debts. All right. So that's a great thing. And if you look at this program, one of the key things is they pay off all their debt. And then by year 11, not only have they paid off all their debt that they were scheduled, but they also paid off all the loans that they used to pay off all their debt. And if I look at this gentleman, he wanted to retire at age 75. So we retired at age 75 and had him a pretty good nest egg. At this point, he can retire at age 55. He'll have $1.5 million. This is year 20. He'll have $1.5 million in the bank. And the annual return on that in this scenario is $130,000. That's 130,000 minus 32. Just be real, right? So it's 100,000. So he's going to be able to retire with $100,000 a year growth in this program. That's through the course of a dividend plus a guaranteed interest rate. Pretty strong. So I have another version that we can look at, which is a student. It's no different. They've got different styles of debts, so we don't really need to go into that too much because I do want to have some time for some discussion. So I'm not going to go ahead and do that part of the presentation. We don't need to see it, but these programs work for everybody. There's a misconception that you have to have a mortgage, or there's a misconception that you need more than just a mortgage, or that you need more than just a debt. That's not true. If you're going to do this and you're not doing a debt snowball, then you're just doing what's called an infinite bank. And infinite banks are amazingly powerful tools. They are the Swiss Army knives of investment programs that are out there because of the fact that we can we can eliminate taxes. We can grow this at our heart's content. We're not limited like you are with a Roth about how much money you can put in per year. You're not limited like an IRA about when you can pull money out or when you have to pull money out. These are really, really flexible tools that you can mold to your need. All right. So there's the end of that one. The last thing I would say is whoever invited you here, get back with them. If you need, they know what they're doing. And if they don't, or if they're relatively new, I'm sure they can find someone to help them. But these programs are powerful tools, and you shouldn't, the longer you wait, the longer it's going to take. And if you look at a 20-year run of one of these programs, if you take off the first year and eliminate the downline compounding because the person waited 1 year longer, then the performances of that program is reduced by about 15%. They're getting about 15% of that gain happens in the last year, and that's the effect of compounding. So time is of the essence when it comes to when you should or could start these. One other thing I'll say about that is there are laws that govern these programs. Those laws do change, and they changed last year, for example. So we don't know what's going to happen in the future as far as the laws that are governing these. But once you take these programs out, you are then locked in under contract law as it states that year. So you don't have to worry about them changing the rules next year. Because if they do, it doesn't matter because you're grandfathered in. So start it sooner than later, get it rolling for you, learn how to use it. Don't be bashful, ask questions. All right. So now, yay. Is anybody asleep yet? Did I knock anybody out? Correa, wake up. Look, it's the Pat Slingo, everybody. Pat Slingo. All right, so let's take some questions. We got some chat going on here. What do we got over here? Yes, Sean Bowman, I know you want to go to Tahiti. There you go. Can you change the view to a better picture? Probably not. No taxes because, all right, so Mark Creighton. No taxes because the policy conforms to the IRS definition of insurance. If the policy fails, the MEC structure, then loans would be assumed to be a last in, first out basis and become taxable, right? So our goal here, folks, is to make sure we design these programs so that they will not be a MEC, okay? And then as we discussed a couple of weeks ago, even if it is a MEC, it's still pretty damn good, right? The growth is still pretty strong. All right. There we go. All right. Hey, Sydney, nice to see you. All right. So there's no questions in chat. Does anybody have any questions for me? If not, I'm going to bring on Mark Creighton. Let's bug him for a minute. Kim Horn, with whole life and term life on the DFL, if the client has health issues, is it difficult? Right. So these are life insurance policies, period. Right. So if they're going to do one of these programs, they have to be able to qualify life insurance underwriting, whether it's term or whole life. The underwriting is going to be with Mutual Trust, and I believe with Foresters and also with Lafayette. The program is underwritten as a whole. So the requirements or restrictions are going to be whatever is the more restrictive of the two, which is going to be term. Term underwriting is more harsh than whole life. All right, Mr. Slingo, you are unmuted.
Yeah, about 3 or 4 slides back, you had something that showed number of payments, and it was like 1, 2, I saw 11 in there.
Yep.
Is that the number of payments you're using to pay off that debt?
So, right. Okay. So let's go ahead and back there, and I'll show you what I'll see. What,
No, it wasn't that one. Oh yeah, there it is. Okay.
right.
Yep.
So the total payments in this scenario is the number of payments that are going to be made before you pull the trigger, take the loan, and pay the debt off completely. So in this scenario, in month 1, they're making 1 payment on it, and then there's enough money in the program they were taking out to pay off that care credit bill, which was $394 at that time, and the 2018 back Virginia state taxes, which was $770. And then in month 2, they're taking enough money out to pay off that Wells Fargo carpet bill at $976. In month 3, they took out enough money to pay off their Visa Barclays card at $1863. And the reason why this program works the way that it does and so well is because of that roll-up deposit amount, which is that's the debt snowball. So each time you pay off one of those debts, the minimum payment that you were paying on that debt service gets added to what you're paying back to yourself, back into your private bank. So by the time you've paid off that Visa Barclays card, the total debt roll-up deposit amount is $236. So you're paying $236 more per month because you've taken loans and you're paying yourself back.
Now, yes. Well, yeah, I was curious about the number of payments. So the next thing is, how are you paying that extra money in? So like, you know, you're up here at the 530. Okay. How are you paying that 530 back into the program?
So that's carrier specific. So, you know, usually there's going to be an online portal that you can go into, and you can say, I'd like to change my premium amount. I want you to take an extra $536 a month until I tell you otherwise. And so, you know, the same method that they're taking money from your account, you just want to take more.
So you're not, the client is not manually paying that extra money for the most part.
So yeah, But I mean, I have clients that don't want anybody coming into their checking account.
I got you.
They just want to write a check every month. So you'll have to check with your carrier. Some carriers will allow that, some won't. Okay. But if you have that person, then they're writing a check every month and they're doing the math and they're making a bigger check out every month.
So since Mark Creighton's here, does mutual trust allow them to go in and online and change their deduction online or their input online?
Our clients have the ability to control some levels of their premium payments activity online. You can make premiums if you want to change an ongoing draft, just a little bit more, but not difficult to do.
Yep. Let's see. Kaleo, so your question was about using a credit card and paying it off monthly. That's not a debt that you can schedule to be eliminated because it doesn't incur a debt. They're paying it off every month. They're using that as like a banking instrument. So that's not something that you would schedule as a debt elimination piece. All right. Oh, Brett. So Brett and I are thinking the same way. Right on. Right on, Brett.
Hey, Scott.
Yes, sir.
It's Kurt.
Hey.
Got a question for you.
Might have an answer. Might even be right.
What's the timeline that mutual trust, I guess, has to do a loan? Because obviously, to pay a debt,
Gotcha.
you got to take a loan. And so, how much time? Because I pay my bills like today is the first of the month, and I like pay my bills when the first 5 days of the month. So, how long should I give for mutual trust to supply a loan for when I get ready to pay my bills?
You want to take this, Mark? You want me to do it?
I would love to.
Go for it.
Our stated objectives of processing a loan is 3 to 5 days. I will confess our loan activity in certain points of the year, like especially right now, we hit a high, so we might be pressing 5 or 6 days. We strive to be 3 to 5, and we are 80% of the year. When volume gets high, it might take a couple days longer. Loan comes in, it's processed again within the 3 to 5 days. We want to send you your loan proceeds via electronic deposit. For all of your clients out there, that is the fastest way for them to get that. Takes 2 days. Once we hit the button to hit send, it'll be in their client's account. So what I would say is plan on a week.
Seven business days.
Mm-hmm.
All right. Thanks, Mark. Thanks.
Right on. And Pat Slinger, you look a whole lot like Scott Summers right now. I'm just telling you. All right. All right. Anybody else got any questions? If not, I'm going to turn the floor over to Mark. Dr. Creighton, floor is yours.
Oh, so much good stuff here. Thanks always for having me. Couple points I wanted to make. Scott was talking about that 80-20 rule, and everybody remember what the 20% was for emergency, right? Here's a true story from one of your Symmetry colleagues. Called me up 3 months after the clients had put their policy in force. His husband's wife had lost her job. Anticipating getting a new one real soon. She's a teacher. This is kind of something that happens every once in a while with where she's a teacher. Contracts gets terminated and she has to wait to get picked up. But at the time, there's nothing coming in, no certainty that it's going to be there. Life does happen, but they needed the flexibility. Because they didn't stress out their policy, it was really easy to make an adjustment to accommodate them until they got back on their feet. Got word just the other day that they're back on their feet. They're going to resume the payments. Didn't have to lose their coverage. Didn't have to undo what they've done. The plan was flexible enough because you left the emergency in it. Emergencies are real. They happen. 2, when you do this DFL plan, don't ever forget that there is an economic value to the death benefit. The greatest return on an asset that anybody could ever see, challenge you to find the product, would be if, God forbid, something happened to your client that first year, that second year, even that third year. the economic value that that family will get from the death benefit that's put in force, that was just there to get them out of debt. It wasn't about the debt, right? This isn't about debt. It's not about death benefit. We don't care about death benefit until it happens to matter to somebody you have as a client. It will matter more than anything else you've ever done. And they will thank you that one day you talk to them about getting out of debt. Cost of waiting, absolutely true. Wait a year, lose 15%. Cost of waiting, wait a year, are you insurable anymore? What do we do about the client who might not be able to afford that DFL? You can't, you're working to get them efficient with their dollars. You ever heard a guaranteed convertible term? Guarantee their insurability, guarantee their debt-free life plan. Put the term policy on them today. It's cheap. You got them covered. When they have the premium freed up that you can create the true debt plan, then convert that term policy. We can show you how to do it.
Mark, let me comment on that for just a second, because that's a standard thing that I do with all clients, especially husband and wives. So I will write a term policy on the husband because he's more expensive, and I'll write the wife's DFL policy. And as soon as that DFL policy for the wife fills, I'm going to convert the husband's term into a second DFL. This is a great plan also for people that are, they're growing over time. They're going to be making more money next year or the year after that or whatever. They just don't have enough money right now. It's a great tool and a great way to get them prepared for that. And if I'm not mistaken, Mark, for the agent that does things that way, isn't there another commission that gets paid at the time of conversion?
We love to pay on every piece of business written.
There you go.
Yeah.
So,
so absolutely, cost of waiting is twofold, both in how the policy is going to perform because they're a year older, and two, we don't know what happens, do we? Three, I've never done this before, and what I've got in front of me is my policy. Scott mentioned that things change, right? They can make a change in the industry, and the CARES Act in 2020, they slipped a little thing in there that required every insurance carrier to reprice their products. My policy was issued prior to that change. My policy, this is a contract. You understand what a contract is? If I do my part, which is pay the premium, that's not premium. If I pay my premium, this has to happen. This tells me exactly in year 20 what my cash value is going to be, guaranteed. Guess what can't change? That number, ever, no matter what. The interest rate that we use changed. This policy does not change. That is the assurance. It's the knowledge. It is the power behind why whole life works for your clients, why it is the backbone of every financial plan, why all the people in the know own products that look like this. What else do we got? That 4.8 million that Scott's clients are going to have when they eliminated debt. Is it the policy that made 4.8? Is there 4.8 million in the policy? No, there's some. It's good. It's really impressive. But they got 4.8 million because they freed up cash flow, because that little tool allowed them to have a plan, execute a plan, and use their wealth to create more. Again, it's what the smart people do.
Yep. Right. Oh, and just speaking of smart people, I do have a thank you to pass along to you. The CEO of Gerber, the baby food people. Yeah. I did a policy on him 3 years ago. He's loving it, and he thanks you, even though they're part of Western and Southern at this point.
I thank him.
Yep. All right. So anything else you got? Any other words of wisdom, Mr. Creighton? I got 3 more minutes slated for you.
I don't know what I'm doing.
You don't know what you're doing?
No, I'm too excited.
Can I say one thing about Mutual Trust Life? Is that one great thing about you guys is if you have people that are kind of iffy, you don't know about health, they have reinsurers. So it's not just them that are insuring the clients. They will put your clients out to a lot of other people to get them covered.
Yeah, I have a comment on that too. I had a client that was declined from one of our other carriers, and then sent it to mutual trust. And then mutual trust sent it out to the reinsurers, and we got her approved on a table 2. So thank you very much for that.
Oh, can we talk about table ratings?
Sure, go ahead. Love table ratings. I love table 4. I love table 4.
Table ratings. That's what we do. Your client's got some health issues, and we need to charge them just a little bit more for the premium. The reason we do that, again, we're a mutual company. Scott was talking about participating. Participating is fun. It means that they get a share of our dividends, our profits. There are non-par whole life policies out there. In fact, just a stock company just come out with one. And but they create guaranteed, cash values. They're fine, but the profits go to somebody else. They go to stockholders. Table ratings is our way to ensure that the client is paying a representative a fee for the risk associated for all of our other policyholders. Table ratings are not forever necessarily. If your client's health improves, we can come back and reevaluate that table rating. First of all, they're absolutely not forever. We drop them after 20 years. They're gone off the policy. We stop counting for that risk. If your client's health improves, we can come back a year later, typically no earlier than a year. And the underwriters will look at the case, they'll get some information, and they'll say, hey, good news, now you're standard.
Yep, there's one more thing I know, Mark, because I wrote one 3 years ago on a family member who was a smoker at that time. They were in the process of quitting at that time, but they hadn't been quit for more than a year, so they were still technically a smoker. Came back 2 years later, they are now a non-smoker rating. It increased the performance of the policy by 30%.
Yes, indeed.
Yep. So right on, man. Okay, so Ruth Slingo. Hello. It's nice to see you. Hello, baby Ruth. Hey, what agency, what agency are we at Symmetry?
We are the hottest agency in Symmetry.
Yes, we are. Right on.
Hey,
So
I've got something I want to say really quick. I wrote 3 single premium whole lives, and within less than a month, they got issued. And so the amendments just came through. So I'm waiting to upload those, and they're getting funded. So that was super cool. $100,000 a piece. We ended up going down to 75 a piece, but still $75,000 a piece. 3 of them issued in less than a month. That's amazing. Amazing. So thank you, Mark. Thanks, Scott.
Yep. Great annuity alternative. Great way to duplicate some funds, some portion of it. It's a great tool. There's all kinds of ways. Again, back to that whole Swiss Army knife concept. Okay, so let's do this. If you guys have another question, go for it. If not, I'm gonna go ahead and start talking about the annuity stuff. So where is that one?
I had a question on the term. You said if you start a term and you can later convert it, does it have to be with a specific company?
Yeah, you can't convert a company's term to another company. You have to write the term with the company you want to convert it with. So if you're trying to convert it into a participating whole life, that term policy better be with a company that A, allows conversion, and B, has a participating whole life that you can convert it to.
And C, allows you to convert to a good product and not a dog you'd never ever sell.
Yeah, right. Yeah, right. Yep. Yeah.
Hey, Scott.
Yes, sir.
I've heard you talk about the positives and negatives of IULs based on age. Can you touch on that just for a second?
Well, we can have that conversation offline. I don't want to dog IULs right now. They have a place, they have a purpose. I'm very opinionated on this. And I don't want to, this is about debt-free life and our whole life. So let's keep it there. All right.
Thank you.
All right. So one of the things we look at for these programs is retirement. Okay. So retirement is, I've got money. I'm no longer working. I need to start deriving some money from this to do whatever I want to do with it. I want to play with it. I want to fund my daughter's college. I want to send my granddaughter to a summer camp in Alaska, whatever. Okay. So it's money that I can use for things that I want to, whatever I want to, or I could use it for income. So from an income perspective, the amount of money you can derive from these par whole life programs is substantial, depending on how long the program's been active and how you're funding it. Okay. So if I'm looking at this and I'm trying to derive an amount of money from a DFL program, and let's say the DFL program grows to 400 grand, and in that $400,000, I am able to derive without affecting negatively the program. I'm able to derive, let's say, $20,000 a year. That's the guaranteed interest rate growth plus a potential dividend. I'm able to derive $20,000 a year. If I do that, then the program is going to stop growing, certainly at the rate that it's growing now, but it is still permanent. Okay, is 20,000 all I need? So this is where when we're looking at these as part of a financial tool, this is not the financial instrument. This is a financial instrument. And this is a financial instrument where you can derive additional funding for additional financial instruments. So I've talked about this before in the form of an annuity stack, a derived annuity stack, a debt-free life daisy chain annuity stack. All those things that I just said, they are exactly the same thing. Okay. All I'm doing is I'm taking money from my DFL regularly. I'm depositing it with another carrier that offers me an annuity with strong performance that facilitates my goal of how much money do I want to make per month? How much money do I want to make per year? Okay. So here's an example. So, oh yeah, also, by the way, if you do what I just described to you, you are significantly increasing the client's net wealth by a factor of about 3. Okay, 300%. So here, let me show you how it works. Okay. So, oops, there you go. Wow. Do you guys see my screen? Does it say debt-free life daisy chain annuity stacking?
Yes.
Yep. Great. Okay. So that means I'm moving around. I'm got multiple monitors set up now, and I don't know which monitor is showing where. I apologize. All right. So here we go. So if I look at, so first thing we have to consider is the annuity stack size. Okay. So what's the unit size going to be? So 10,000 is going to be the minimum unit size. So if you're looking at into the future to derive an annuity stack from a debt-free life or an infinite bank, you have to think into the future and look at the performance of the DFL of when you're going to be able to take an amount of money out regularly over a period of time. That period of time, you can do this over 6 years. You can do this over 4 years. You can do this over 3 years. You can do this over 2 years. Or if you've got enough money going here, you can do it annually. Okay. So whoever's not muted, would you please mute yourself, because I can't see on my screen at this point. All right. So where we go from here is we're looking at that debt-free life and daisy chain annuity stacking. And here's those numbers. So we're going to use a $10,000 example. This is a 3-year example. So if I take $10,000 4 times a year out of my debt-free life program and I deposit that into an annuity, a couple things we're doing here. First off, that money is what we call non-qualified money. Okay. So qualified money, I would have to pay tax on all of it. As a non-qualified money, I don't have to pay tax on the principal that I started it with. Okay. So we're starting a non-qualified annuity. First off, private pension indexed annuity, right? So $10,000. And if you look at, there's a specific month that I'm doing each one of these things. So basically in a 3-year program, I'm trying to take at least one $10,000 tranche of money, one $10,000 amount of money out of my DFL each quarter in a specific month and start an annuity in that specific month. And the reason why is because I'm going to have this regular cycle. When I pull money from an annuity, I can do it annually, semi-annually, quarterly, or monthly. If I take it annually, in many cases, the performance is going to be stronger than if I take it monthly. So what I'm trying to do here is, rather than derive just one annuity, I'm trying to derive a series of annuities that I'm stacking on top of each other they're going to come to fruition. They're going to come to they're going to mature in every month of the year, so that every month, once all of them are matured, after I get to the point where I want to start taking income from this, I can take money every month from a different annuity, but I'm only taking it one time per year from that individual annuity. That keeps the performance level high of that annuity. If I put in $10,000, the average return is going to be $1,162. If you look at that 16th year forward annual withdrawal, at that point, I am taking only a portion of the gain. So this is where now we're talking two different things. We started talking with the DFL. We've gone through that, understand how that works. And now I'm deriving a second investment from the same DFL. I'm not spending any more money with my DFL. The DFL is on automatic pilot at this point. Okay, it's self-funded, it's self-funding, it's growing on its own. I'm taking a derived amount of money with regularity, however I want to, as we just described, and I'm taking it from my DFL and I'm putting it into my private pension indexed annuity, or I'm creating, in this case, a $10,000 private pension indexed annuity in January. Then I'm creating one in February, and then one in March, and then April, and so on, so that over a period of time, I get 12 of these built. Okay, so I've transferred exactly $120,000 out of my DFL program. This is not coming from a brand new DFL, folks. This is from either a very large DFL, or this is coming from a mature DFL. Okay, so I'm taking 120,000 out. Okay, and that number should be enough that it's not gonna cause the DFL to implode. So you have to do the math. So now I'm taking 120,000 out. I'm putting it into a program that is going to create over time $280,000 of wealth. That's with that standard rate. And this is actually a year old now. And this was using Athene's Performance Elite 15 annuity. With, at this time, I think it had a 12% bonus. They just changed the bonus to 15%. So this is actually going to perform even better now. Okay. So I'm going to grow 120,000 to 280. I'll do that game any day of the week. Okay. Even if I'm just doing it for growth, I'll do that any day of the week. Right. But here's the kicker. In this annuity stack, I'm going to derive money as income from it. Okay. And that income is going to be, in this case, $13,944 a year. That is not enough to negatively affect the growth of that annuity. All I'm doing is I'm taking some number that's less than what the annual growth is. So if I look at this investment, $120,000 from 3 years, it's derived. This is a 3-year derivation. 3 years derived from my debt-free life program. I'm deriving a stack of private pension annuities. $10,000 is the unit size over a period of 3 years. I'm going to let it grow. So if you're 70 years old, you can't do this. You don't have time. This is something you do for a younger person. My growth is 303% in the 20th year. Where that annuity, the value of that annuity will be, it'll be at 303% of where I started. And at that point, I will have taken $13,944 5 times, which means not only did I grow the core value of those annuities to 303% of where I started, I've actually also taken over $60,000 of income. Okay, so I'm gonna let that sink in. This is what's called a debt-free life daisy chain annuity stack, a private pension annuity stack. That's it. I mean, you can call it whatever you want, but it is what it is. I'm taking money that I'm using in my DFL. I'm cycling through my dollars. I'm doing my debt snowball. I'm getting rid of my debt. I'm getting to the accumulation phase at least. And then at that point, you could start taking it at the accumulation phase, depending on how the program is structured and what it looks like financially. You could actually derive the annuity stack while you're still in the accumulation phase. It'll delay potentially delay getting out of it might put you back in the maximization phase, depending on how many loans you have to take to do it and how the program's growing. But it would probably be worth it because the income you're going to derive from the annuity stack is going to be superior to what you would derive in most cases from the DFL program. So I'm taking $13,944 a year from this, and from my DFL program, that would be me taking $40,000 a year. So I'm going to delay my $40,000 a year for a couple of years until I can do this program like this. All right, so I'm going to shut up for a second. That went pretty quick. And let's see if anybody's got any questions.
I got one.
Mr. Boatman.
Hey, listen, I'm always good to raise some really uneducated, dumb questions. I'm here for that sole purpose.
Right on, man. Let's hear it.
Well, okay, so I mean, I'm used to thinking about DFL so much as just like a get out of debt kind of program, but you know, I have a high value client. I mean, she's seriously concerned because she's worth like 80 million. And so she's looking at something going, okay, I'm going to have my beneficiaries are going to have estate taxes. They're going to be absurd. And so she's looking at something going, how am I going to get away from them just losing half of the estate's value in taxes? So could we switch, like, would she be able to make like a single premium if she's got the cash to do it? Would she be able to make like a single premium whole life policy where she just parks that in that policy right there? It's guaranteed to earn that guaranteed interest rate. She's in a sense, like right off the bat, created her own bank right there with the death benefit already in place. And that's just structured that way just for estate planning. Would that be
right? So look at it this way. If I have $10 million cash and I die, and that cash transfers to my beneficiaries, there's a potential for them to, let's use $20 million, okay? And I transfer $20 million to my beneficiaries. There will be a taxable event because I'm going to exceed the maximum amount of non-tax and an estate, which is I think it was $11.2 million, I think is where the number is right now. Life insurance is something where you can leverage this. You can actually take that 11 million, whatever it is, some number. It's going to create more of a death benefit for that, which means she could, in theory, turn her $80 million, which is going to cause a taxable event for a bunch of people, a big one, okay? And she could break it down into initial death benefits, into using the single premium whole life vehicle. She could break it down to individual death benefits so that I'm going to give you $11 million when I die in the form of life insurance. It's not going to be cash. It's going to be life insurance. And because it's life insurance, it's not going to be taxable. So you can leverage the amount of money. You can do this with anybody. So you can leverage the amount of money that you're going to leave as a family. That's actually a strategy when we're talking about estate transfers. We want to compartmentalize the exposure of taxes, and that's a way you can do it.
So she just takes the cash and parks it, and then she just avoids the taxes by parking that cash into a life insurance policy instead of just having it sit liquid in one of her accounts. And there
is a maximum that she can. It's not going to be her that's avoiding it; it's the estate. Okay, there is a maximum that you can avoid on an individual basis. But what I'm saying is, if she puts it all on the estate, and then the estate pays out all that money to, let's say, 5 people, and they're all receiving more than 11 point whatever million dollars, then there's going to be a taxable event for those people that receive it. Okay. But if I put it into a single premium whole life, and I'm going to pay this person 11 million death benefit, not taxable. This person 11 million, not taxable. This person 11 million, not taxable. And she could spread the wealth to more people and give each of them larger amounts of larger money than what you would be with the 80, and also avoid those taxes for the people that are getting larger portions. So, you know,
that's all handled on one policy, just with 4 different beneficiaries. What you just described, or I totally missed that.
I think you can have up to 8 primary beneficiaries on these programs, but that doesn't mean you can't do more than one program.
So just in the example, because this is the only one that I know of at the moment that I'm kind of trying to puzzle through, she's liquidating a bunch of commercial real estate. So can she 1031 exchange the funds from that into one of these?
Like kind. Yeah, that's a starker exchange, and you can exchange one investment for a like kind investment and avoid taxes on the proceeds. So if she's selling commercial real estate, then she can buy commercial real estate without having a taxable event.
Okay, so she's going to pay her life insurance policy with post-tax dollars, but then the death benefit will not be taxed to the beneficiaries.
Well, yeah, I mean, it's life insurance. Yeah.
Okay, got it. Understood.
Yep. Does that help you?
Yes, thank
Great.
you.
Did I make that plenty muddy for you?
What's that?
Did I make that muddy enough for you?
No, it's helpful to
Buddy?
me. I mean, that's helpful to me because those are things that are just kind of rattling around my brain. I didn't know the piece about like investments, but when you say it's like, oh, that's true. I've heard that before.
So for real estate, it's called a 1035. That's the tax code Starker exchange. That's real estate to real estate, business for business, gold for gold. That's a like kind exchange. In insurance, it's still a 1035, but it's not called a Starker exchange. And it's going to be life insurance for life insurance.
So anybody that has cash sitting aside should put it there. There's no downside to parking it in a participating whole life policy.
Nope, not really. Other than there's going to be a premium for it. So the participating whole life is going to have a premium. Whether you can structure them as a single pay. I think Mark showed us a couple of weeks ago how to structure those as a single pay program. Okay. They are super efficient as far as you're looking at 95, 97, 98% cash efficient as a single premium program, the way that Mark showed us how to do it, which is brilliant, by the way. Mark, great job. But that you're don't you represent the company? So so there's a bonus there, but there isn't the single premium whole life is a mech. Okay, so there will be a taxable event at some point when you realize funds from it, unless it just pays out as a death benefit. Mark, is there a taxable event if the person never receives income or funds from the DF from a single premium whole life and it simply pays out as a death benefit?
Zero taxable events in that case.
There you go. Right. And is there a ceiling as far as how much you could do in one of those programs? Or is it does it fall in line with the 11.2 estate deduction?
No, there's no limit on the size of the policy outside of qualifying for the death benefit.
There you go. So you probably would not be able to put $80 million into a single premium whole life policy. I imagine might have issue with that.
Somebody give me a call. Let's try it.
Love it. Right on. All right. Thanks for the question, Sean. All right. I got a few minutes left. Anybody else have any questions, or are you guys thoroughly bored yet? Oh, somebody raise their hand. If you raise your hand.
I do, Scott.
Okay. Mr. Desario.
What is up, everybody? Hey, Mark.
Hey, where's Courtney?
Where's she at?
Yeah,
you know where she's at. She's right there.
Hey, Courtney.
So a question about the annuity stacking. You did the example, and I've said that to people. I said that sitting with clients. I just sent out a hard text to all the clients I have from infinite banking that said you do it now or forget about it, or it's going to be your opportunities will be gone. And within 5 minutes, I booked 6 appointments automatically on my calendar. I took it away. I was like, you can't have it anymore. Anyway, so I'm excited about that. I'm excited to write some policies with Mutual Trust Life because Mark has spent quality time with me. But back to the annuity stacking, you had the example of every quarter you did every 3 or for 3 years, every other or the 4th month, whatever it was, and then you had a 15-year Athene product, right? Yep. Is it possible to do it with a 7, 10, and 15, or is it better to do it with
you can do it with any. So the difference between a 7-year annuity, a 10-year annuity, and the 15-year annuity is going to be performance. Right? For a 7-year annuity, that means you're taking 7 shots at the market going up. Okay. For a 10-year, you're taking 10 shots. And for a 15-year, you're taking 15 shots. So the 15-year is going to outperform a 7-year. Okay. The 10-year is going to outperform a 7-year, 15-year is going to outperform a 10-year. That's the first key piece. The second piece with that is how much can you withdraw? So on a 7-year annuity, typically you're able to withdraw up to 10% per year. On a 10-year and a 15-year, you're limited to 5 typically. That's the second piece to consider. And the third piece to consider is bonus. A 7-year annuity is most likely not going to have any bonus. A 10-year annuity is going to have maybe 7%, maybe 10%. And a 15-year annuity, like the Athene's new one, is now a 15% bonus on the day you roll it over. So when you're looking at that 15% bonus versus a stack of 7-year annuities with 0% bonus, by default, the 15-year one's going to outperform by at least 15%. Okay, so you have to take those things into consideration. How much money do you need to withdraw? Is 5% enough? How much money do you have to put in over what period of time? Do you have enough time? You know, you can't do a 15-year annuity on somebody who's 70 years old. So, you know, there's other factors, but yes, you can do an annuity stack with a 7-year or a 10-year. The only thing I would say is be consistent with the annuity that you do, right? Because like if you mix and match and do 3 7 years and 3 10 years, you know, something like that, then the penalty to access the 10-year annuities earlier, if you're taking more than the 5% it allows, like if you're trying to get 8% income, that's no problem with the 7-year, but you're going to have a penalty with the 10 years, and it's going to cause a problem with long-term performance of the annuity.
Right. So I've explained to some of my clients about annuity stacking, and what I've explained to them was you could do like a 7, a 10, and a 15. And in 7 years, you get paid out all your money.
That's
you get paid out your money.
That's not the kind of stacking I'm talking about. That is a stacking structure. And I do that all the time when I've got larger chunks of money where I'm trying to do financial planning for the client, trying to figure out, okay, when do you need access to money and how much do you need? So if there's like a gap, there's usually a gap. It's usually like 2 or 3 years from the time they're going to retire to where their Social Security kicks in and they've got enough money coming in, but they want a little bit more. But they might need to, you know, I'll put a smaller amount of money into a 7-year program that gives them a 10% withdrawal amount. And I'll use that to cover that 2-year window. And that all along, I've got the majority of their money in a 10-year or 15-year program that's getting that bigger bonus and it's getting that longer term compound. Okay. But it doesn't have anything to do with a derived annuity stack from a DFO. That's annuity strategy.
So that's clarification. And one more question about when you pull the money out from the DFL.
Yep.
Put into annuity.
Yep.
You have to pay that back, right?
Well, as long as you structure the program properly, and there's no one answer to this. You know, if you're cutting a razor's edge, you know, thin line about how the program is going to perform, then I say you better do your math. Okay, make sure, you know, don't just look at 1 year, look at 7 years, you know, look at what it looks like in 7 years. If you've done that, is it still performing? Okay, you know, run the numbers. So, but thanks, Brett. Good question.
Thank you for the clarification.
Right on. All right, anybody else?
Yeah, for that. So just as an example, I was going to ask Ruth this, but maybe you guys will have some insight on this because you guys know this stuff.
Ruth Bader.
So that's those $75,000 single premium whole lives that she wrote.
Yep.
Are they dollar for dollar or?
Nope.
Okay, so the premium that they paid for that $75,000 would be approximately what?
75,000.
So it is dollar for dollar, which
is not dollar for dollar. So let's make sure we're talking about the same thing here. If she paid $75,000 for the single premium whole life, there is not going to be $75,000 of cash value that she can touch immediately. Okay, I think that number is somewhere around somewhere in the 3rd year. Go ahead, Mark.
Ruth, how old was that client?
That client was 64 years old.
Okay, give me a second. People got to do math in my head.
And the death benefit went to 118,000.
Yeah.
Okay.
So approximate guaranteed cash values on that 75,000, and I'm going to give you percentages. You guys can do the math. Year 1 guaranteed cash value 95% of the 75. Year 2 about 98. Year 3 plus.
That's right.
Plus.
That's exactly what it was.
All right, Mark. So that's 75,000 that they put in bought $118,000 of death benefit.
Yes.
And I think that goes to Sean's point. You know, she does this money. She can, like you were saying, they'll actually gain more in a death benefit because however much they put, okay.
Yes,
It was
it's
just
leveraging a legacy.
Yeah, because it was just sitting in his checking account and his plan was to give 100,000 to this one, 100,000 to this one, 100,000 to this one. And so I just did 375,000, named the beneficiaries, and he still has access to his cash and it's earning 3% interest.
Right. And he'll be back up to full value in 3 years.
And he can still use what he needs to use.
Yep. It's a beautiful program.
And the way Ruth set that up with that specific client who wanted 3 separate policies, I've seen it done that way. And I've seen another one client put in about 300,000 and split it between the 3 kids, meaning 3 beneficiaries. Either way works. Do it in 3 policies. You get 3 policy counts for it.
Yay.
It's a little more paperwork, but not when you can just add the additional.
It was
Scott,
so
you know-
simple. So
Yeah.
simple.
Come on, Mark. The MTL e-app is simple. Simple.
Hey, guess what we're working on?
I
When
bet
you
you
go
are.
in- Pretty soon, when you go into the e-app, you're going to be able to elect if you'd like the policy sent to you or the client.
Yeah. Nice.
Yeah,
That made Betsy dance. I love it. What else?
I always have it sent to me anyway, because I always want to look it over and make sure I send them the signature document beforehand and get it back, and then I'll ship it off to them. Costs me a little bit more money, but that way I make sure everything gets taken care of.
I like it. Well, I'll just say that e-app really is easy. I had to do 2, husband and a wife. Although now that I hear about the term, I'm like, oh, I should have done that. I learned something today. But it was super fast. We just went right through it, got it signed, boom, bang, it was done. It was
Hey,
awesome.
Mark, did you know that you can check a box on your application if you're writing a term policy and a horizon value policy and a single policy, a single premium policy, all in the same person, that you only have to do the app once? You just check a box and have it be for multiple apps. Just
I do
saying.
know that. I do know.
Just saying. All right, Betsy, you're still unmuted. You got anything else you want to say?
This was fire. Thank you. Thank you for pouring into us. We always appreciate it.
Yeah, Mark, thank you very much for coming here. We appreciate you. So thank you, everybody, for showing up. Hopefully you got something about this. We will be back on September the 22nd, Thursday at 5:30 p.m. Our special guest at that time will be Mark Barnes. And we will be going over some alternative ways to do illustrations, some things you probably haven't thought of. So thanks, everybody. Have a great night. Go ahead and help the family. Bye.